How is everybody? Woohoo! Yeah. Oh, relaxed. You'll be falling asleep on me before I know what's going on. Okay, tonight our topic is conscious investing for peace of mind. So we're going to go into the mind a little bit tonight. And as you know, some of the stuff that we've done has been a little bit, if you've been to a lot of these education classes, we get into the mind, because what have I said over and over and over that is most detrimental to the investor?
Trust me.
That works too. So it's going to be a rough night. Patience. That's good. But also, it's our emotions that get in the way. So we're going to talk a little bit about that because, we've had a pretty good euphoria year with investing, right? It's been a grand year. But trust me, the market's going to go down. I just don't know when it is. You don't know when it is. Nobody knows when it is. But it will go down again. Now, does it fall all the way down like it did in 2008? Let's hope not. It could. It could go worse. We don't know. So we're going to talk about some of this is getting into our own minds, because that when the market crashes again or has a recession or has a drop back, even if it's 10% or 15% or whatever that number is, we've got to understand how the markets work so that we don't freak out. And that day will come. That hot state will come. The hot state's when you get into that emotional feeling of when the market all of a sudden drops 500 points in a day. Okay? And then what happens? News media is all about it, right? So we're going to talk a lot about that today. First of all, our mission, I don't know if anybody's been on our website, but we have our mission on our website, and it's Fike Advisors is a family-owned organization whose purpose is to help families make prudent and educated decisions when it comes to their money. We accomplish this by educating and coaching through monthly education classes. Our investment strategies are backed by academic scholars, taking the complex world of investing and making it simple to understand. This is on the front of our website, and right here it says, your peace of mind is our ultimate goal. So tonight we're going to talk about conscious investing for peace of mind. So it's right up our alley, and this is what, you'll see where we get into this whole peace of mind thing. As you can see up here, this is our website. If anybody ever has been in there, or if you'd like to go in there, it's fikeadvisors.com. We have a monthly blog that gets entered on there. That monthly blog also hits LinkedIn, Facebook, Twitter, and Google+. So any of you social media heads out there, I'm sure you guys are all lining up for that. We do a blog once a month that hits all of those and shows up on our website. And what a blog is an article. It's a short article about something. So if you ever want to keep up on that, just keep checking that. Also, we'd like you to go in, if anybody does do any social media, you can go into LinkedIn, linkedin.com, and then search. There's always a search in any of these, Facebook, LinkedIn, Twitter, or Google+. You can search in there for Fike Advisors and it'll pop up. And then what we'd like to have you do is like us. And then whenever a blog comes on, it will actually email you a copy of that blog. So it's pretty cool stuff. It's just a way to connect. This is the future, whether we like it or not. Social media is here to stay, and it just keeps getting bigger and bigger and bigger. So the Fike Advisors, we had to jump in on the social media, obviously, but it's kind of fun. I don't know that it reaches a lot of people at this point for us around here, but we're there. So if anybody wants to check us out. So tonight we're going to talk about that peace of mind. What is it, and how can we find peace of mind when we're investing? Okay? Well, usually what most of us do when we're trying to figure out how do we gain peace of mind, especially in investing, we go out and we look into the media sources. Newspapers, magazines, television. This is where we find our peace of mind. And here's some examples of some history of peace of mind. This is October 99, Smart Money, where to find the next AOL, Yahoo, eBay, Cisco, Internet Stars of the Future. Get this magazine and we'll show you how to do it. Kiplinger, pick stocks like a pro. You can be like a pro stock. And all you have to do is buy this magazine for $2.95. The next thing you know, man, you're picking stocks like a pro. Isn't that something? And then we got when the things are really good. You got the Newsweek coming out saying everyone getting rich. So everyone's getting rich because things are doing so well, except me. Ooh, now we threw a little fear in there, or some kind of envy or something where, oh, everybody's getting rich except for you. And then when things are really ugly, you got, how scared should you be? The market's wild confidence is shaky. What can you do now? So the news media has always got this little answer, and we're always searching for this peace of mind, and we get caught up in this stuff. Looking beyond the bear. Yes, it's scary out there, but a recession is a sure thing. Isn't a sure thing. Here's why. Check out the cell phone with a little antenna. This was 2001, I think. 2001. So we had antennas on our cell phones in 2001. I think I had one till like 2005. Everybody was giving me a hard time. You still got an antenna? I go, but I like that phone. Had to pull the antenna. So peace of mind is hard to find, and we're always searching and we're always seeking. And back in 2009, I took this class actually in the fall of 2009 at Matson Money. And when I took it, it kind of waked me up as far as the advisor side of the world. Because my father and I always thought that if we could help our clients build large accounts, get your accounts to grow and build lots of money, that our clients would have peace of mind. They would have this financial independence where they would have this peace of mind. But in reality, as I'm sitting in that class, I started thinking of a couple of examples of people that we had as clients at that time who had amassed some wealth, but still were very unstable. They didn't have peace of mind. An example of one was a lady that we had, and we still have, but she had a little over $2 million in her account, and she was pulling $20,000 a year out. Now that's 1% of her account, which is pretty low. And we had many conversations with that lady, explaining that you could have a little bit better lifestyle if you really wanted to. You have plenty of money to do that. But she didn't have peace of mind. She was worried about the stock market going up, stock market going down, interest rates going up, interest rates going down. She was caught up in all the media stuff. She had a couple $1 million, lived very simply, really didn't need a lot, but she was a nervous wreck, always worried about her money. And on the flip side of that, we had a guy who had a little over $800,000, and he was pulling almost 4% of his assets out, so he was pulling about $30,000 a year out. Happiest guy you ever met. Still alive today, still a pretty happy guy. But he would volunteer all the time, helping people out. He would give money to different philanthropic stuff, like little volunteer and nonprofits. He would give his money away. He would take little short trips all over the place. He had peace of mind. Even though he didn't have $2 million, he was living on a higher income than the lady that had the large account, but he had peace of mind. So what I learned out of this is that what we have been doing all this time was we were worried about investors being financially independent, but we missed the point that just being financially independent is not going to give you peace of mind. There's more to it than that. Because you can be financially independent and have all this money, but what are you going to want? You want a little bit more, and you want a little bit more, and you want a little bit more. You got to dig a little deeper than that and find out what is it that I really want. And then the number on the monetary statement isn't so important as it was. It's still an important number. We're not going to go away from that, but we just need to try to focus on some different stuff or identify why we don't have peace of mind. So tonight we got 3 strategies to help you find peace of mind. One is we're going to talk about how to raise your consciousness. The other is we're going to understand how the investor mind works. And we're going to learn your answers to the 20 most must-answer questions. Some of you guys have been through that. We're going to go through them tonight because I think it's important, and I'll tell you why in a little bit. So, first of all, everybody's got to stand up.
They got to sit down again.
Yep, you got to sit back down just when you get comfortable. Remember that position right there. Everybody's got to stand up. I want you to grab your rope. Hold it one end in each hand. What do you got there? No, that's a broken rope. Here, you want a good rope? All right, so what I want you to do, without taking your hands off of each end of the rope, I want you to tie a knot in the middle of the rope. You can't take your hands off of them. Keep trying without taking your hands off the end of the rope. Yeah. You know, don't let it come off your hands.
Can I be in it?
Nope. It's got to be in the middle of the
Oh, it has to be.
tight knot. Pull it tight. Yeah, pull it tight. I can. Olin's got one back here, but it sure does look funny. I'm not sure how he did that. Because it's physically impossible to tie a knot. All right, so set it down on the table. We'll show you how to do it the right way, legitimately. All right, so take your left hand and put it on your right bicep. Put your right hand and tuck it down in like the old Indian powwow. I want you to pick up one end with your right hand. Okay? And pick the other end up with your other hand. And you should be standing like this. And what you do is you go like this, and you have a knot. You didn't let go. Once you picked it up, you didn't let go. Okay. How many of you knew while we were doing this that there was a way for it to be done, but you just couldn't figure out how to do it?
How do people actually tie knots without letting go of their rope?
We'll talk about that later. We'll have to see that. That'll be the end of the show explanation. So how many thought that there's got to be a way to do it? It's one of those trick things, right? You always know there's a way to do it, but you just can't figure out how to do it. How to get out of the box, so to speak, right? So why did we just do that? The idea is that sometimes we know that we have to get out of the box to figure something out. But it's very difficult to get out of the box because the box is us, okay? We are the box. And it's very difficult to step outside of ourselves and look at things. Okay? So, we step out of the box and look at ourselves. We can't really do it real easily by ourselves. So sometimes we have to go out and find help. We have to find some kind of a system, somebody that knows how to teach you how to do that. There's all kinds of different plans and ways to be able to look outside the box. So we're going to look outside the box a little bit today. So we'll go through all the directions. We've already done all this. Some of you got knots before. I'm still trying to figure that one out. We'll get to that later. So the first strategy, remember the 3 strategies. This is our first one. We're going to raise your consciousness. So what is conscious? It's aware of oneself as a thinking being, knowing what one is doing and why. So conscious is knowing what we're doing and why we're doing it. And unconscious is taking actions without awareness. So we have 2 parts going on, right? We have what we know that we're consciously doing, and we have our unconscious that's doing stuff all the time, right? There's lots of unconscious actions going on. In fact, it's called mind chatter. Mind chatter is stuff that's going on all the time. As I'm sitting here talking, I can't talk fast enough to occupy your mind. So mind chatter is going on. While I'm talking, you might be sitting there going, oh, I got to get that turkey for Thanksgiving. Oh, I got to take my dog to the vet tomorrow. Oh, that's right, I got to get the kids to school. I mean, you have all these things going on while I'm sitting here talking. Some of us call it daydreaming, but it's really mind chatter. And psychologists say that the average person has 50,000 thoughts per day. Now, that's an estimate, but they estimate about an average of 50,000 thoughts per day. 80% of those thoughts are the same mind chatter thoughts you had yesterday and the day before and the day before. So we're like this broken record. We got this record going on. Michelle's laughing. You got this record, And it's like the needle stuck in the groove over and over and over and over. So it's very hard for us to sometimes get out of these unconscious mind chatters. So 4 ways to raise your consciousness. We have to become more aware of what we're doing, be more aware of our environment, who we are and what we're doing at the particular moment. To do that, we have to recognize this mind chatter, this negative mind chatter that keeps going over and over and over. We have to be able to recognize that. If we can be able to recognize that, then we can turn it into positive mind chatter. It's very hard to do. But one way to do all this is to know the facts. You got to have facts to stop that mind chatter. And here's a perfect example of conscious and unconscious. And I'm going to guess just about everybody's done it. I go to church, I drive across Smithville Western, and if I go to work, I drive across Smithville Western, but I turn left on Friendsville Road to come to the office. Now, more times than not, I go across Smithville Western, I turn the turn signal on at Friendsville Road, and my wife always goes, "What are you doing?" I'm going, "I don't know." I turn the turn signal off and I go to church. My unconscious behavior, the unconscious mind chatters tell me to go left, when I'm really consciously, I need to be going straight. Anybody ever have that happen? You ever go to the wrong place when you know you're supposed to go somewhere else? It's very typical. So this is some of the mind chatter going on. And what happens when it gets into investing, we're going to talk about how that affects us in our investments. So how do we get the facts? Well, let's first of all examine the mind. Told Russ and Kent we're going to go into the mind today. So psychologists tell us there's 3 parts to our mind. One is the cognitive part. This is the part that gives us logic, it gives us the facts, reasoning, it's our intelligence, it's things that we know. If you remember, if anybody ever watched much Star Trek, who was the logical man? Dr. Spock. They always went to him for the logical answer. Dr. Spock knew how to use just his cognitive part of his brain, and that's why he was so unique. But as humans, we have 3 parts, and we can't just separate that. The other part is instinct. It's how we behave. It's survival. It's intuition. It's how we react to things. But mostly it's survival instinct given to us from prior generations. And then we have emotions. How we feel, trust, fear, greed. These are all our emotions. So we have 3 parts to our human mind. Cognitive being what we know. Instinct plus emotion will overpower what we know. So if our instinct, our survival instinct, and our current emotion at the time become more powerful than what we actually know we should be doing. And this is true in everything, but it's very true in investing. So cognitive knowledge is less powerful when it's up against instinct and emotion. So what is cognitive again? It's the process of knowing. Knowing what you know that you know. So in rules of investing, if we're an investor, what do we know? Does anybody know the 3 rules of investing? I got a $25 gas gift card if somebody can answer that. And we have said it many times. The 3 rules of investing. If anybody's watched any Mattson videos, he brings it up all the time. He says it all the time.
Buy low, sell high.
That's one of them. What's another name for that? Buy low, sell high. He's trying to get a gas card out of me, but he's only got 1/3 of it right now. Rules of investing. Number 1, we need to own equities. Equities is the greatest wealth creation tool known to mankind historically. It's always performed. 2, you need to diversify your portfolio. Not just own one equity, not just own a couple equities. You need to be highly diversified. And 3, buy low and sell high. He's pretty proud up here. And that's the same as what we do every quarter in the Matson portfolios. We buy low and sell high, and that's called rebalancing. They're buying the asset classes that are low and selling the asset classes that are high. This is our cognitive known facts. Okay, we know this about investing. It's 3 very simple rules, but it's extremely hard to ever do. And I'll show you why in a minute. Here's another one. Who knows how to lose weight? Because I certainly don't know how. Whoa, it's a rough crowd tonight. Well, what's the 2 rules for losing weight? Does anybody know?
Eat less, exercise.
Move more.
There you go, right on the money. Move more, eat less. Take less calories in than what you spend in a day, and you'll lose weight. It's very simple. But mind you, the weight loss industry is a $7 billion plus industry. Go to the library, there's a whole rack of weight loss. Go on the internet, there's just millions of websites on weight loss. Why is it so stinking hard? We know the facts. This is the known facts. This is the cognitive part of the facts. That's correct. I'll tell you an example of this right here. Will. But it's based on instinct and emotion. And we'll talk about that in a minute. I'll tell you an easy explanation of this that happened to me. It's been 15 years since I've been on a cruise, but I remember in the late 90s going on a cruise with my wife, 5-day cruise, and her and I, back then I used to work out, on a regular basis. But anyhow, we won't go there. So we said we're going to go on this cruise, we were going to walk a lot, and we weren't going to kill ourselves eating because that's what everybody does. Everybody gains weight. We go on the cruise, we walk up the gangplank, we do all our things for 5 days. We walk back down the gangplank, get home, we gain 5 pounds each. In 5 days. If I did that for 365 days, I'd be 365 pounds heavier than I am right now. We knew the facts. We had the plans to do the facts, but we got into our survival instinct and our enjoyment of our emotions.
It's called greed.
Greed of food?
Greed, take advantage of the free stuff.
There you go. Part of the emotion. So what we know is overridden by how we behave, which is our instinct, and how we feel, which is our emotions. So cognitive, what we know, is not as powerful as how we behave or our survival instinct right here, and our emotions. So let's look at instinct. We just looked at what we know, the 3 rules of investing. We know that weight loss is very simple. We know investing is very simple, but it's so difficult. What's instinct? Inborn tendency or a primal biological urge that motivates behavior. So instinct is behavior, survival behavior. Let's look at an example. Can you give me one behavior or one survival instinct that humans have? Pain, perfect. I think you read the book. That's good. Pain. Give me a couple examples of pain. Back pain, knee pain, emotional pain. We don't like pain, do we? Primarily, we've been geared to not like pain. So what do? We run away from pain. Some examples of pain are hunger. We don't like hunger. We don't like to be really cold. We don't like to be really hot. We don't like to be lonely. So that could be, that's another pain. Especially if after they come out, it's a whole other issue for the next 20 years. Did I tell everybody to turn their cell phones off? Sorry about that. So pain. What's the opposite of pain? What's another instinct? Pleasure. We love pleasure, don't we? What's some ideas of pleasure? Eating. Cocktails for some. Love. Safety. Making love. Warmth. It's all pleasurable. So let's talk about the investor dealing with pain and pleasure. And actually, if we talk about pain and pleasure, it isn't always a perfect world. Because There are some things that are pleasurable but are painful. If I'm Tiger Woods, for instance, pleasure creates a lot of pain, right? Okay, cheating around with all those women caused him a lot of pain. He thought that was pleasurable, but it caused pain. On the opposite side of the court, you got pain. Well, our survival instinct says that we want to be able to survive. We want pleasure that will make us survive at a longer pace. But how about commitment to good health? How about exercise? We all know that exercise will give us a longer survival instinct, which is pleasure, knowing that we're going to live longer. But who wants to get on the treadmill for 10 or 15 minutes? That's painful. So it's not a perfect pain and pleasure world, because some things that are good for us we consider painful. And this gets into the investing side of the world as well. So let's say it's the end of the year and you open up your statement and it's the end of 2008. Boy, that was an ugly year. Market crash, very ugly. So at the end of the year, long-term government bonds made 25%. Small U.S. stocks lost 38%. So what is this right here as far as an instinct is? Pleasure. That's right. We're happy. We're up 25%. Glory days. What about over here? What are you feeling? You're feeling pain. So what's everybody do when they feel this pain? They run from it and they go over here. Well, that did so good this year and this did so. What am I doing over here? I'm going over here. I don't like this pain. I like that pleasure over there. That's our natural instinct. The other side of that is that our cognitive, our knowledge, can really mess with us sometimes too, right? Because if we're looking at this, we're sitting here in a logical standpoint going, well, man, if my accounts go down 38% for the next 3, 4, 5 years, I'm broke. Well, that's logical fact, right? And if I'm over here and it's going up 25, 26% every year, I'm going to get rich. So I'll go out and I turn on the TV and I read the internet and I go, oh man, everybody's saying you need to be buying long-term government bonds. They just had a great year. So what you do is you end up moving, you're going over there. You just got reinforced from your pain. You just got reinforced to go to pleasure, and you got backed up by the news media. Let's see what happened the next year, 2009. Bonds went down 14.9%. These are fact numbers. U.S. small stocks went up 47.5%. Now all of a sudden, we're going back over here, aren't we? And we have no peace of mind whatsoever because we're running all over the place. So that's instinct, pain and pleasure instinct. Now let's talk about emotions. What are emotions? It's a strong feeling, a complex reaction to both mental and physical components. We're going to do a little quiz here. If you go to page 8 in your book, you'll see the quiz. The answers are scrambled. So I want you guys to shout out what you think the answer to this. It doesn't matter how sophisticated his charts are or how much sense he makes. I just don't feel comfortable letting him handle my money. Fear? Oops, did I just... Mistrust. He doesn't trust them. Next question. I'm not sure if I should have put my money in that fund. It's already lost 15%. Maybe I should sell it. Some of it tomorrow. Regret? Correct. Next one. My boss got 25% on his money. I only made 8%. Gosh, I wish I had that 25% too. Envy. Investor envy. We have a great deal of that that goes on in the workplace. People always bragging about how much money they made. Is it truth or fiction? You don't know. So I wish I'd know that stocks were going up. I would have bought more shares. Greed. My dad worked in that company all his life and left his money to me in his will. It would be wrong to just sell it to diversify my portfolio. Misguided loyalty, but loyalty. What if the market drops tomorrow and I lose it all? These are just some of the emotions that we all experience with different things. And we've heard all these in our office. Every one of them from somebody and more. There's all kinds of reasons out there. And so what happens is we get these emotions based on we have smartphones, we have internet, we got radio, we got TV, we got the e-baby who says how easy it is to trade stocks. Very easy. You don't even have to be more than a baby to do it. We have financial advisors. All this clutter coming into us, creating emotional instability, creates all this non-peace of mind because we're completely pounded with this stuff. And every day, wherever you go, market's up, market's down, why this, why that, some guy predicting this. You go on CNBC and it's all about day trading, Well, you need to sell this, you need to buy that. I mean, really, it doesn't really have anything to do with you. It's just that's how they get paid. Again, what we know is not as powerful as instinct plus emotion. But what happens is the media magnifies our instinct and our emotion. So instinct plus our emotions times what's out there in the media completely overrides what we know is best for us. And what's the 3 rules of investing? Own equities, diversify, and rebalance. 3 basic rules. So simple, but yet we get all this going on that takes us away from that. Here's some more stuff. How to profit for the Y2K. This book was written in 1999 by John Malden. He said that the Dow will drop from 9,000 to 5,000 after Y2K. I guess you could say that actually happened 8 years later. Happened in 2008. But it didn't happen when he thought it was going to happen. And the other side of the coin is Harry Dent, the Roaring 2000s. He wrote this book in 98. He said, the Dow is, due to the fundamentals of the market changing in a predictable manner, this should create a peak Dow of around 21,500. This was in 1998. And then he went on to say, or maybe 35,000 by year 2007. The Dow hit 16,000 today. It's the highest it's ever hit. Closed over 16,000. This is the crap that's out there, and we see it. These are bestseller books. These were bestsellers back then. If you followed what they were saying, it could have been detrimental. Again, all the clutter, magnified by the media. Instinct plus emotion times media overrides what we know is facts. And remember, facts are what gives us the peace of mind that overrides the negative mind chatter. All right, so everybody stand up. We got another game to play. All right, so we have 4 asset classes, right? Large U.S. stocks, small U.S. stocks, treasury bills, and large international stocks. So we're only going to deal with 4 asset classes, and you guys are going to predict what you think happened in the future. So in 1969, can you see that all right, that's red? Does that show up pretty good for you guys? Okay, so in 1969, in this example, treasury bills had the best asset class of the year. Okay, treasury bills did better than any of these 4 asset classes in 1969. In 1970, treasury bills had the best asset return for that calendar year. So for 1971, I want people to raise their hand who think that U.S. large stocks are going to be the number 1 asset class in 1971. Raise your hand if you think that U.S. large stocks in the next year are going to be the best asset class. Nobody? How many think that small U.S. stocks are going to be the best asset class in 1971? Hold your hand up if you think so. How many think treasury bills are going to be the best asset class in 1971? Remember which asset class you said. And how many think large international are going to be the best asset class in 1971? Okay. Here's 1971. The best asset class was large international stocks. So anybody who did not pick large international stocks, sit down. Those who did pick large international stocks, stand up. That's pretty good. I was in a class of 50 advisors that took this, approximately 50 people. None of us got this one right. And Matson says, good thing you guys aren't trading stocks every day. Everybody be broke because of you guys. He said, I did a group of plumbers and they did better than you guys. So anyhow, okay, so we're going to do the next year. We're going to see who can last this thing. So don't sit down yet if you're still in. So 1972, who's got large U.S. stocks? Anybody? This is a whole new year, so you can pick a new category. We got one. Small U.S. stocks. Who thinks that's going to be the best asset class? Treasury bills. Who thinks that's going to be the best asset class? And large international stocks. Who thinks that's the best asset class? Large international stocks won again. So if you pick those, stay standing. If you didn't, sit down. Okay? All right, 1973. Who's picking large U.S.? Got a couple over there. Who's picking small U.S.? Who's picking treasury bills? Who's picking international stocks? Treasury bills. If you pick treasury bills, you're still up. Everybody's gone. This is how hard it is. We don't know. We keep going down the list. Could you imagine being a money manager thinking, I know where I'm going to put our money next year? It's pure gambling if you don't think that they can, if you think they can pick that. If you think there's research that tells you that they know which asset class is going to kick butt next year, nobody knows. It's impossible to know. You guys just felt how hard it is to pick that out. So what's the idea? If you have a Matson portfolio, you know that we own all those asset classes plus 15 more. We have 19 asset classes. We want to cover them all because you don't know which one's going to be the hot one for the year. All right, so there's three things that might be a sign that you're gambling with your money. Does anybody know what those are? Horseshoe casino, roulette. If there's a pair of dice in your future. Stock picking, trying to pick it. What's that? Timing, trying to time different asset classes. Stock picking, basically stock picking. I'm trying to pick, you can either pick individual stocks or you're trying to pick individual asset classes just like we just went through. Active money management does this all the time. If you're not buying in a passive portfolio where they're not trying to predict or trying to guess what the next hot stock or asset class is, then you're gambling if they are. If they're trying to stock pick or trying to asset class pick, they're gambling. Or they're trying to time the market. I hear this all the time. I have clients that call in here and say, I got, $10,000 I want to put in, but, the market's just been soaring and I don't want to put it in right now, so I'm just going to hold on to it for a while, maybe for a month or two, and we'll see how things go. And hopefully it falls back down and then I'll put it in. I had a lot of that earlier this year. And guess what? They're still sitting there waiting to put it in because the market has not reversed. And what if the market reverses and they finally call and say, all right, we're going to put it in right now. And it's down for 2 or 3 days, but then it keeps going down for 5 or 6 months or a year. They missed that market too. So there is no way to time the market. Believe me, I've tried to look at it over and over and over again. I've been doing this 30 years. I'm pretty sure Pop back there at 52 years will tell you the same. Or track record investing. Track record investing is picking a mutual fund that has a great track record. I used to do it all the time for you guys. We'd pick 5-star Morningstar funds. You know what a 5-star Morningstar fund is? Morningstar is a third-party rating company that rates mutual funds. And most of the advisors use them. And what they do is they go back and look at the track record of that money manager with that mutual fund and go, well, they've had a great 10-year run, so that's a 5-star fund. There's absolutely zero correlation that money manager can do the same track record the next 10 years. There's no correlation. In fact, it's been proven the complete opposite. And so what happens is so many times you have people out there who think they can pick stocks and get you a better return. There's people who think they can time the market, get you in and out because they know what's going on. Or there's people who think that you can invest your money based on how well this particular fund's done. And it's just not true. It's all gambling and speculating. In fact, Mark Twain put it, October, this is one of the most dangerous months to speculate in stocks. The others are July, January, September, April, November, May, March, June, December, August, and February. That Mark Twain, he pretty knew, I think he might have known a little bit about it. I don't know. So how do we increase peace of mind? First, we have to raise our consciousness. You have to be aware of what's going on. We have to try to identify that negative mind chatter and watch out for the media that creates that mind chatter worse than what it really is. And we have to understand the three parts of the brain, the cognitive, the instinctive, and the emotional, and understand how it works when it comes to our investments. And we have to understand the three basic rules of investing, which are buy equities, diversify, buy low, sell high, which is rebalance. Our money managers at Matson rebalance every 3 months. It's scientific. It doesn't matter what's going on. They are rebalancing. As we speak this year, we have bought more in the bond market than we have in a long time because bonds are down and stocks are up. They're rebalancing your account every 3 months. Something you and I probably wouldn't do, right? Remember the pain and pleasure screen up here? We'd be going, why are you buying bonds? They're going down. Because someday bonds are going to come back and be the butt kicker again. And when they are, we bought them on sale. And we sold the stocks while they're high. And if they continue to climb, we're going to keep selling stocks off and buying bonds because someday it's going to go the other way and then we're going to buy, we bought all that stuff on sale and then it's going to be a reverse order. That's rebalancing. And it's done scientifically. So remember that our mind is very detrimental to our investing and we have to stick to the facts. And how do we stick to the facts? We got to be able to answer the 20 must-answer questions. So now we're getting to the test level. And on the back of your book, the 20 must-answers are yes-no questions. So I'm not going to really pick your brain too hard. But if we're going to stick to the facts of investing and we're going to try to block out that news media, we got to understand what the facts are and continually feed our mind. We continually stimulate our mind with what the facts are. If we're not going to listen to the news media, then we got to be able to listen to something that's going to keep us on track. And so this is what the 20 must-answer questions are about. Every one of our education classes have something to do with one of those questions. In fact, I'm working on designing a book where everybody would have the 20 must-answer questions and you would check off in that book what class you took so that you would know the answer to each one of these questions. So the first one is, have you discovered your true purpose for money, that which is more important than money itself? We did a true purpose for money class. Does anybody remember coming to that? It was pretty in-depth. But what this class is about, true purpose for money, and if you know your true purpose for money, you can answer yes. But I'm guessing if you weren't in that class, most people don't know what their true purpose for money. It's your true purpose that is more important than money itself. And in 1 hour, maybe an hour and a half for that class, you go through that, you will know what your true purpose in life is. What your true purpose is for your money. What's more important than that account value. Mine is gifting for love. That's my true purpose for money. And I always have that true purpose. Whether my account's worth X amount of dollars or worth X amount of dollars down here, I still have a true purpose for my money. And I quit focusing on what the dollar amount is at the bottom of that page. Yes, we want to see it go up. That's important. But we have to have, our peace of mind has to come from what is our true purpose. Remember the lady that's got $2-3 million in her account? She's not happy. She has no true purpose. Her whole goal is, my account's got to get bigger. It's got to be bigger. It's got to be bigger. It's got to be bigger because I don't have any, I'm not comfortable. She's never going to be comfortable. She had 10 million or 20 million in that account. She's still not going to have true peace of mind because she doesn't have a purpose for her money. So if you can answer yes to that, check yes. If not, answer no. Are you invested in the market? This is a very simple one. You either own equities or you don't. In our mutual funds, if you're in Matson's, you all have equities. So you own equities, you're in the market. Preferably equity mutual funds and not individual stocks. Do you know how the markets work? Do you know why stock prices are where they're at? Does anybody know why Coca-Cola is at a value that it's at today? If you don't know, then we'll do a class on this. But if you don't know, this is a no. If you know exactly how markets work, you can check yes. Have you defined an investment philosophy? There's basically two philosophies. One is markets are efficient and markets work, or markets fail. And if you can't separate the difference between that, then you can't answer yes to this question. But if markets are efficient, that means that stock prices are always at the correct value. If they're inefficient, that means the stock prices are not at the correct value. Perfect example, and I've done these in other classes. If a can of soup on the shelf at the grocery store is priced too high, what happens? Nobody buys the can of soup. If the price is too low, what happens? Tain't no soup on the shelf. So what happens eventually is the price is always the right price. The consumer decides what the right price is. Now, it doesn't work in gasoline. That's not really a free market in my world, but that's what free markets, that's how stock prices work as well. We'll do a whole class on that. So investment philosophy is either you believe markets are efficient, that they work, or markets don't work. And if you think they don't work, then I think that was first written by Lenin. Anybody remember Lenin? Not the rock and roll Lenin either. Have you identified your personal risk tolerance? Have you put a scientific number to what your risk tolerance is? What kind of roller coaster are you willing to go on? And probably everybody in this room has been through that with me. Okay? And if you know that you know what your number is, or you know that we've been through that, then you know what your personal risk tolerance is. It's called a standard deviation. Do you know what your number is? Yes. If you don't, no. Do you know how to measure diversification in your portfolio? Everything that we've gone through, whenever we first went in the Matson, we talked about correlations, why we have different percentages in your portfolio, different mixtures. That's how we diversify. There's reasoning behind that. There's academic proof behind it. 80-some years of study. So if you know how to measure that, then that's a yes. If you can't remember how we did it, we'll have a class on that. And you can check no. Because pass-fail doesn't mean anything today. You still pass. Do you consistently and predictably achieve market returns? Do you know if you're getting market returns in your portfolio? Have you ever compared them to benchmarks? If you look at the first page of your Matson statement, there's always that little paragraph that tells you what happened for the last quarter. The right-hand column will show the free market mutual funds in 3 different categories, and it compares the free market mutual fund to other benchmarks in that category. So every quarter, you're getting that little to see how you're doing compared to the rest of the market. We'll do a class on that too. Have you measured the total amount of commissions and costs in your portfolio? I think we've all talked about what kind of costs we're into. But there's so many out there. We've all talked about trading costs that we never see, buying and selling going on in these active mutual funds. It's horrendous. Some of them are 100, 150% turnover. That means they're churning the portfolio 150% a year, costing tons and tons of money, and you don't even see it. It comes out of your returns. So if you know how to measure that, you understand that, you can check yes. If not, we'll talk about that. Do you know where you fall in the Markowitz efficient frontier? Remember the curve we did? When we decided on what kind of risk level or what kind of mix you want to do, that's the Markowitz efficient frontier, that curve. If you don't remember, you can check no. If you do, if you know where you fall on that, that would be a yes. When it comes to building your investment portfolio, do you know exactly what you're doing and why? Do you know why we have those asset classes in there? Do you know why we rebalance? Do you know all that? These are facts. These are help us get facts so we can eliminate all the emotion and all the instinct. Are you working with a financial coach versus a financial planner? Hopefully, we can identify that we are trying to coach you guys into understanding how all this works. Do you have a customized lifelong game plan to guide all your investing and spending decisions? Some of you have, some of you don't. The idea behind this is, do I have a purpose for every one of my accounts? Do I know what that account is there for? And that's just a matter of us sitting down and talking about it. Some people have never done that. Some of you have. You know exactly why you have money in different places. Do you have an investment policy statement? Everybody has an investment policy statement. It's in this room that has Matt's and money. And it's everything that we went through. And we went through that whole paperwork to find out what kind of risk level you're at. That created an investment policy statement. And in the 3-ring binder that you have, if you open that up and go into the middle section, which is advisor correspondence, and look through there, you will see a page that says investment policy statement. And if you read that, it'll show you exactly why we designed what we did. It was all because when I went through that with you, we went through question after question, page after page, and we whittled down to an investment policy statement. But you have one. I mean, how many things do we do in our life that we have no policy for doing it? We need to have that. It keeps us structured. It keeps us on course. It's a fact. It's a cognitive fact. Have you devised a clear-cut method for measuring a success or failure of your portfolio? Again, this kind of goes back to comparing it to benchmarks. Do I know if I'm successful or not? I've had people come in my office this year and go, oh, that aren't clients. Oh, I'm having a great year. And you look at their portfolio and you go, really? As long as you're happy. Because you sit there and you go, you're not even anywhere where you should be. But some people don't know what success or failure in a portfolio is until they've experienced it. Do you fully understand the applications of diversification in your portfolio? Why do we have to diversify? There's all kinds of reasons. If you know why we've done all that, all those different diversification, all those little different applications that are in there, the scientific formulas to get us to our diversification? Yes. If not, no. Do you have a system to measure portfolio volatility? Again, it goes back to pretty much, do I know what my risk level is? Standard deviation. Are you aware of the incentives broker firms and financial communities have when selling commission-based products? Brokers, your big brokerage houses, they all have incentives, trust me, for selling products. If I am Merrill Lynch, I have inventory. I'm not going to just pick on Merrill Lynch since I have a camera on me today. But if I'm Merrill Lynch, I have an inventory of stocks and mutual funds that I own, just like a warehouse of them. And believe me, there's a special of the week going on all the time because there's commission-based incentives for those guys to push those products. Happens all the time. It's been on for years. That's one of Wall Street's big tricks. Do you know the 3 warning signs that you are gambling and speculating with your money versus prudently investing it? So, what is the 3 warning signs? We went through those tonight. Now, this one everybody should get. Or did I throw too much at you tonight? Three warning signs. Stock picking, that's good. Next. Market timing, next. Track record investing. So you can answer yes to this because we went through that one tonight. Can you identify the cultural messages and mindsets about money that destroy your peace of mind? I think everybody should be able to answer yes to that because that's exactly what tonight's class was all about right there. Cultural messages from the media and our own personal mindsets that create all our non-peace of mind. So that would be a yes. Unless you're Lori, then that'd be a no. Oh, she didn't get me on that one. I was trying to pick on her. Are you ready to shift your personal experience from money and investing from a scarcity mode to abundance mode? That should be a yes. And basically what we're saying here is an abundance mode is having peace of mind and understanding how the markets work, how my portfolio works, so that there is going to be a day when the market is going to go down and it's not going to be so fun. And what we don't want is any of our clients freaking out and panicking, because that's the worst thing we can do. Emotional behavior is the worst thing to the investor. It creates nothing positive out of it. And the idea of these education classes is to go over it and over it and over it with facts. And the facts are these 20 questions. If we know the answer to all those 20 questions, we understand how the market works, and we will not freak out when the market has another dip. It's going to have a dip. We don't know if it's tomorrow or if it's 10 years from now. It's going to have a correction. It always does. And that's good. We want corrections. Because if we had no correction, we would never have the kind of gains we have today. That's volatility. Good volatility is going up like crazy. Bad volatility is going down. But volatility goes both ways. We want that. If we didn't have that, we'd have money sitting at the bank, earning nothing. There's no volatility in that. There's no risk in that money. It's short-term money. So if you take no risk, you get no growth. And it's worked for well over 100 years. Actually, if you go back 300-400 years, clear back to the days when they traded tulip bulbs, risk works. But there's been recessions and depressions throughout. And actually, I have a PowerPoint on going back 300 years, Matson did, on recessions and depressions of the world. It's pretty interesting. All on different trading methods. Maybe not the U.S. stock market type trading, but all on the same basis. It's pretty interesting stuff. So, what did we talk about? Peace of mind, 3 key ways to achieve it is to raise your consciousness, get rid of that negative stuff, be able to identify it so that we don't let it get us down. Perfect example of negative mind chatter. I'm going along, great day, and all of a sudden I'm grumpy. And you sit there and you go, well, maybe you really didn't think about it, but if you really sit and think about it, why am I so grumpy all of a sudden? Well, you go back a few thoughts back and something happened, or some mind chatter thing was a negative thing. You started dwelling on it. It might be that everyday thing that you dwell on, and it ruined your attitude for the rest of the day. That's mind chatter. So we need to raise our consciousness, understand how that mind works. Instincts and emotions override what we know are the facts. Stick to the facts. Stick to the facts of investing. I'll stick to the facts of trying to lose some weight. That's another tough one. And it's so simple, right? And then learn these 20 must answers, which is going to require that you guys start coming to some education classes. I got Carrie from CNC Video videotaping tonight. And we're going to try to start videotaping these because there's lots of times people can't come. So hopefully this works out. Hopefully it doesn't ruin our live classes. But I'd like to be able to do this where I can send them out by email and you guys can watch them in the comfort of your home if you can't make it. Still like to have you come here though. So this is something we're trying to do because there's a lot of, I mean, we have well over 250 clients with Matson Money, and we have, what, 25, 30 people coming to a class. So I'm okay with that. At least I have some people who want to learn, but we'd really like to reach out to more. So great work tonight, and we wish you guys all a happy Thanksgiving, happy holiday, happy Hanukkah. I got my gold. Does anybody have any questions on any of this?
Brad, I think you deserve a big hand. Very, very good.
Oh, thank you.